everyone, and welcome back to Forward Finance. In today's video I'll be going over some basic financial metrics such as PE, PS, price to earnings, current ratio, etc. to educate you. This is intended for beginners, and it will prepare for some future videos on how to screen for stocks, how to value stocks, how to find things that may be at a bargain, things like that. So let's get into it. So the first thing that I'd like to talk about is the stock price. And the stock price, as we can see, I'm looking at Coca-Cola for an example here. The stock price is probably the most common thing that retail investors, laymen look at. And I just want to make clear, I want everybody to understand that the stock price is not information. It is not useful. The stock price doesn't tell you anything except for what the stock is being traded for right now on the market. So that's about $48, $49 here for Coca-Cola, but this is not useful information. So if I look over here, I have another stock. This is Intel. Intel is trading at $57 as of the last close yesterday. But this is also not information. And if I look at $48 here, $49 for Coca-Cola, I look at 57 and change for Intel. This does not mean that Intel is more valuable than Coca-Cola. It does not mean that Intel is more expensive than Coca-Cola. It is not any amount of information. And the primary reason for that, other than some other that we will get into, the primary reason for that is these two companies, and every company on the market, they have a different number of shares trading. So what's important to realize is this $48.77 price here for Coca-Cola, this is just the quote, the last trade for one share of Coca-Cola. And identically over here, this $57.33, that's just the price for one share of Intel. And the reason that I cannot look at these two numbers and compare them to each other and think, oh, it looks like Coca-Cola is cheaper than Intel, or Intel is more expensive than Coca-Cola, or anything like that, the chief reason, or the first reason, is because both of these companies, so this is Intel for example, have different number of shares outstanding. That's a basic metric that we should understand. So for example, if I look at Intel, the number of shares outstanding we can see is a little bit over 4 billion shares outstanding. And what that means is on the market trading, or available to be traded, there are a little bit more than 4 billion shares. So and then if we look at Coca-Cola, that number is going to be different. So one share is this price, but there are more shares outstanding for Coca-Cola. So Coca-Cola, and it's just a coincidence, these two companies have a relatively similar number of shares outstanding, but Coca-Cola has almost 4.3 billion shares out trading compared to Intel's 4.063. So that's about 230 million more shares are trading for Coca-Cola than they are for Intel. So that's the first thing that skews this price. So that's the first reason. So there could be other companies. Some companies have many more shares outstanding. I could bring up some examples later, and then some have many fewer. Some may only have a few million shares outstanding, which is a very small fraction of the shares outstanding for these companies. So that's something you need to be aware of. Just remember, shares outstanding is how many shares there are trading on the market. And then the other reason that this is not information is the really important thing is if you want to know the value of a company, what it's trading for in the market, so let's use Coca-Cola here, the first thing we want to look at is market cap, which is short for market capitalization. And this is the sum total value on the market of the shares of Coca-Cola in this case. And in this case, it's just shy of 210 billion, as we can see. And what that means is, or how do we get to that number, is how many shares are there outstanding, so it's 4.297 billion, multiplied by what is the price of each share, and if we just do that little arithmetic equation there, it'll equal $210 billion. And the same thing for Intel. If I want to find Intel's market capitalization, which is a little bit more than Coca-Cola's at this moment, I just take the shares outstanding, multiply it by the price per share, which is $57.33 at this moment, and I get a little over $234 billion. So that's the first thing we should remember. Shares outstanding, how many shares exist for this company on the market, and the market capitalization, the value of the company according to the stock market, which is just how many shares are there outstanding multiplied by the price per share. So now we're going to look at our first valuation metric, and this is one of the most commonly talked about ones. It's a very basic one, and that is PE, or price to earnings. And here for Intel, we can see we have a price to earnings here, and according to this it's 11.74. And what the price to earnings is this price, the P, is just the stock price, the 57.33 in this case. And then, as this slash implies, it is a division equation, arithmetic again, and we would divide the price of the stock for one share divided by the earnings, which in this case we're going to use the EPS, the earnings per share, to get this number. And this number can be useful because what it is, the earnings is the actual profit of the company, and usually in most cases it will be the TTM, or trailing 12 months earnings or profit. And what that means, TTM, it just means over the last 4 quarters, so the last 12 months, the last year, how much profit per share, for one share of Intel in this case, did the company generate. And in this case it happens to be $4.94 and some fractions. So as the equation implies, we would just take the stock price, 57.33, divided by the earnings, divided by the EPS, and we'll get the PE, which would be 11.74. And you can check that in your calculator if you want. The PE, this is the PE as of this closing price, so it would just be 57.33 divided by 49412. That's a decimal there, because this is the earnings per share for one share. So we have to use the price for one share, which is 57.33. And this number can be useful. It can help you try to determine whether or not a stock is under or overvalued, but it's not the end-all be-all. This is just the beginning. There could be reasons that a stock has low PE or high PE, and you would need to compare it to other companies that you're thinking of investing in. You would need to compare it to other companies in the same industry. So for example, if I wanted to try to get an idea from this metric as a beginning of whether or not Intel is over or undervalued, I would compare Intel's PE to similar companies such as AMD, Taiwan Semiconductor, Samsung, Qualcomm, etc. Companies that are in a similar business, because they, generally speaking, since they have a similar business, they all else equal, they should have a similar PE. So if they have lower or higher PE, then we would need to investigate why does it have a lower PE, or why does it have a higher PE, etc. So, but anyway, that's just, you need to understand the metric first. So let's take a look at, okay, so Intel has a PE of about 11.74, and just you can investigate that yourself. You will probably find that in the semiconductor industry, because Intel is a semiconductors designer and producer, it is relatively cheap. It's going to be cheaper than particularly rivals like AMD and Nvidia and some others. But let's just for the sake of looking at it here, we're going to look at Coca-Cola. So Coca-Cola, the same thing. We're going to find the PE in the same way. It's not going to change. It's going to be 4,877 divided by what is the earnings per share, how much profit did the company generate over the last year for one share, and that's just shy of $2 for Coca-Cola. So if I want to get the PE again, this one, all I do is take the stock price, 4,877, and divide it by 1.9282, and you should find in your calculator that it's going to come to 25.39. And so this number is higher than the Intel number, as you can see. Does this mean that Coca-Cola is overvalued or is expensive, or does it mean that Intel is cheap, undervalued, an opportunity? Not necessarily, and particularly it's difficult to compare these two, especially right off the bat, since they're in totally different industries. Coca-Cola is a beverage producer. You know, they make their most famous product, Coca-Cola, and a lot of other products, waters, juices, etc. And Intel, meanwhile, is a semiconductor company. Their businesses are completely different, and so it's very difficult to use this particular point of information to value them. The same thing with Coca-Cola. If I was going to try to find out if it was over or undervalued, I should compare this and other numbers to Coca-Cola's peers and competitors, such as Pepsi, for example, is the first one that comes to mind. Now, another metric that can be useful, and we'll use Intel again for this example, is something called PEG, or price to earnings growth. So this is related to the earnings again, and related to the price. But this time, the earnings are not used in the division, rather the earnings growth is. And the stock price is still the numerator in this equation, and the divisor will be the earnings growth, or the number we divide with, the number underneath the division sign. And what earnings growth is, historically and perhaps projected into the future based on estimates, and it's related to this forward PE, but don't worry about that at this moment. What it means is, what is the rate at which the company is growing, has been growing, and is expected to grow their profit or their earnings. And you can, that's public information, especially for these public companies. You can find, what was their earnings last year, what was their earnings the year before that, and the year before that, etc., as well as what is their estimated earnings for next year and the year ahead of that. Although those numbers may not be solid, they are estimates, so the earnings may not pan out that way. But anyway, it still can be useful information. So there's going to be the stock price, and then there's going to be some metric, the price to earnings, or the earnings growth rate that Intel is exhibiting. And if you look at Intel's revenue and profit, you will find that they have been able to consistently grow that, which is the reason that this number is fairly low. And the price to earnings growth. So even though these companies, Intel is 234 billion and Coca-Cola is 210 billion about in market cap, the size of the company, and yet Coca-Cola's PEG is a little bit more than 5 times that of Intel. And the reason that this number is showing like this is because Coca-Cola's increases in earnings, the growth of their earnings, has been relatively slower than that of Intel. And so that's why that is going to be there. And so generally speaking, if you're looking for a stock that is undervalued, similar to PE, a lower number for PEG is better than a higher number. And again, this does not this does not necessarily cross Coca-Cola off your list as a potential investment. It does not mean necessarily that it's a bad company or that it's overvalued or anything like that, but it is a consideration. And remember, these companies are in different industries, so we have to consider that too. Different industries could have average different growth rates and stuff like that. So we're not going deep into analysis. This video, remember, is just to understand the metrics first and foremost, and you'll learn how to apply them later, especially as you gain more experience. So anyway, now we have earnings per share, PE, price to earnings growth, and the market cap and the shares outstanding. Make sure you understand all these metrics that I've mentioned so far before we move ahead. Now here is another metric that a lot of people I think are going to be interested in, and that relates to the dividend. So here I'm looking at Intel's dividends, and there's 2 things to be aware of. There's one called the quarterly dividend. So in this case, Intel pays a quarterly dividend. Once per quarter they pay out their dividend. So every 3 months. There's 4 quarters in the year. And at the moment, as of their last declaration, it is 34.74 cents, as you can see here, per share. That's per share. Every quarter they pay 34.7 cents. So that means in a year they pay about $1.30 per share. Then there's the dividend yield. And the dividend yield, you can see that they multiplied it. Annual dividend rate is about $1.40. You just multiply this by 4. And then the annual dividend yield, which is currently, if you buy the stock today, if you bought it at the current price of $57.33, it would yield for you about 2.4% over the course of a year. That means that this annual dividend rate of $1.39 is 2.4% of the share price. That's how you get it. So you take, this time the divisor will be the share price in this case. So you have $1.39 if you want to find the dividend yield, and you divide it by the share price of 57.33, and that gives you an annual dividend yield at 2.4%. So if you buy the stock at this particular price, then your yield, if you hold the stock, will be 2.4% each year if the dividend remains the same. So what a dividend is, and you need to understand, it's a little bit different from interest. A dividend is not a promise or an obligation for them to pay you until they announce it by a company, but it is rather an amount by the company's management that is decided upon to pay to the shareholders from the profit of the company, or sometimes just from cash, but generally speaking from profit. So in this case, all these D's, if I look at the historical chart here for Intel, all of these letter D's here are dividend payments that Intel made to their shareholders. So 26 cents, and the dividend amount could be different every time. Although companies do try to keep their dividend stable and raising, because investors like that. You don't want an unpredictable dividend. You don't want an unsustainable dividend, like more than the profit or things like that. And as we can see, Intel has been very reliable for dividend investors who need income. So we can see 26 cents, and then over the years we can find a dividend amount here. Sorry, the thing is a little unreliable. They raised it in 2017 to a little over 27 cents. And then we'll look over here. They raised it to 30 cents for 2018. And then for 2019, we can see they raised it to 31.5 cents. And then they raised it again for 2020 to 33 cents. And then they raised it again. It's not going to show here, but we can see here for 2021, the first payment, they've raised it to almost 35 cents per share. So they have a history of increasing their dividend, and that is very, very attractive as a dividend investor, as an income investor, a growing dividend. Because, for example, if I had bought, let's say I had bought, it's hard to pick this spot, but let's say that back sometime during 2016 or maybe early 2017, I had purchased Intel shares for $30 a piece. $30 a piece. And at the time, Intel's dividend was about 26 cents per share. So at that time, my dividend yield would be based on 26 cents per share times 4, so there'd be $1.04 per year in dividend, divided by the share price of $30 per share, if that's what I paid for them, would result in my dividend yield. But as the stock price of Intel has increased, as you can see over the years, and now it's up to 57.33, it's almost double the $30 that I hypothetically paid for it. My dividend yield, my yield on cost, because the price I paid was $30, does not change. Actually, instead, it goes up, because if the company pays a higher dividend, so originally when I purchased it, Intel was paying 26 cents, but then, let's say a couple of years later, they're paying 30 cents a share, as we can see here. That means my yield on cost, instead of 26 cents times 4 divided by $30, is now 30 cents times 4, so $1.20 divided by $30. So my yield on cost is higher. And that is something that can, that is what you want to try to achieve as a long-term dividend investor. You get into a company when it's relatively cheap, and over time they increase their dividends, and your rate of income goes up based on your cost if they continue to raise it. So somebody could be making even more than that now if they had bought back then, because it'd be 34 cents, 35 cents times 4, 139, divided by the cost of what they paid for the price. But as it relates to this here, the annual dividend here shown on the page right now is based on the current stock price. So that's why it's showing 2.4%, because it's $1.39 divided by this. But again, just to reiterate, if you wanted to find your yield on cost, you would divide the current annual dividend rate, the quarterly dividend times 4, divided by the price you paid for the stock. So it could be higher than this 2.4%, or it could be lower than this 2.4%, depending on what you paid for each share of the stock that you bought. Now, the next thing to be careful of as a dividend investor is you want, it's fine for a company to manage their dividend and raise it, etc., but they need to have profit. They need to have revenue. They need to have the money to be able to pay this dividend. that means they need to have a profitable business. And so we're going to look at something called payout ratio. So if I look over here at dividends, there's going to be more information. And we're going to find something called payout ratio, which is a basic metric. And so what payout ratio is, we can find it here in this case under statistics. The first thing, payout ratio, is the percentage of the company's profit, and again TTM, over the last 12 months, over the last year, of the company's profits. What percentage of those profits did they pay out to the shareholders as a dividend? And in this case for Intel, it's a very healthy 26.7%. That means they only paid out to the shareholders 26.7% of their total profit to the shareholders, which means they kept more than 70% of it to do research and development, to expand their business, to pay down debt, to expand their business, to do many things that a company needs to do to stay competitive or to grow, etc. You generally don't want a company to be paying all of their 100% payout ratio or very high payout ratio, because then that means the dividend could be at risk. So for example, if let's say I had a 90% payout ratio, hypothetically, and then something happens to the industry or something happens to the company and their revenue or earnings declines, they don't make as much money, they don't make as much sales for some reason, if that declines, then that could put the dividend in jeopardy. Because if they don't have the money, if they don't have the cash available from income to pay a dividend to you as a shareholder, they might have to stop paying a dividend, or they might have to reduce the dividend, etc. So all that means is, generally speaking, it's better to try to see a lower value for the payout ratio, because that indicates a safe dividend. It indicates that paying the dividend from the perspective of the company is not a burden at all if their payout ratio is low with respect to their earnings. So in this case for Intel, it looks very healthy. It's it's only about a quarter of their earnings, which is low compared to most peers. And so let's take a look at Coca-Cola, just for perspective here. They do pay a dividend, and it yields about 3.35% at this moment, at this stock price. But let's see what the payout ratio is. So for Coca-Cola, the payout ratio is a little higher. Okay, so it's about 84%. And that doesn't necessarily mean that it's in jeopardy. Coca-Cola also has a history of, generally speaking, raising their dividend, although they did they just raised it pretty much at least every year since 2011. But you should investigate that. Why is the payout ratio so high? Does that mean they won't be able to raise it as quickly in the future? Or, it warrants investigation, because it's not a low payout ratio. But anyway, you can see, first of all, this is just to understand the metric. So to reiterate, the payout ratio is the percentage of the company's profits, generally speaking, over the last year, that they pay out in dividends. So the next metric that we're going to look at here is called price to book, or in this case, price to tangible book. And what price to tangible book is, the price, again, just like the other metrics that we talked about, is the stock price. What is the cost for one share? So in this case for Intel, again, it's still $57.33. And then the book, or the tangible book, that's the value, the accounting value of all of the assets that this company owns. Assets includes buildings, machinery, cash, money that is owed to this company, inventory, accounts receivable, etc. Not intangible assets. And don't worry about intangible assets right now, because that's outside the scope of this video. I'll cover that at another time. But in this case, tangible means what it implies, a physical thing that you can touch and feel. So like I said, cash, buildings, machinery, etc. And so just like the other metrics, to find the PTB, price to tangible book value, you would just divide the stock price by the value per share of all those assets. And in this case for Intel, it happens to be about 5.2. And so if you wanted to find the book value, or the tangible book value for a company, if it's not provided, if you can't find a reliable place for it, you can try to find one per share on Yahoo Finance or some other source. But just in case, if you want to find the raw numbers yourself, then this time you're going to go to one of the financial statements that's called the balance sheet. And a balance sheet shows all of the assets and liabilities of a company. So the assets will typically be on top, the liabilities are below. So we don't need to worry about the liabilities at this moment because we're talking about book value. So here we go. So the assets, so tangible assets, since we're doing the price to tangible book value, will not include things like intangibles over here, or goodwill, or some other things that we can talk about. But it is going to include cash, short-term investments, so that's things, like CDs that are maturing this year, bonds that the company owns that are maturing this year, so they will receive cash, things like that. Accounts receivable, so that's orders that have been made by customers to Intel in this case, and they have not yet received the payment yet, but the order has been made, so they expect to. Inventory, the value of inventory in book, so this is finished goods. They may even include raw materials. They have different categories of it, but basically product that can be sold, that's pretty much ready to be sold to customers and stuff like that. Plus the other stuff that I mentioned, land. Intel owns land where they have their factories or headquarters, etc. They have a lot of machinery and equipment since Intel produces the chips in themselves, that not only designs them like some other companies. They are not fabless. They have fabrication. Construction in progress. There's many different categories of assets, and it might take a little bit of research and homework to figure out everything that you're going to put into this divisor for P, price to tangible book. But that's generally speaking what it is, and we will cover these financial statements in a future video. Right now it might be a little bit daunting, but just make sure you focus on understanding how the price to tangible book value is calculated. So it's the stock price on top, here it is again, divided by the tangible value of the assets of the company, and then in this case we get about 5. For Coca-Cola, it could be different, but Coca-Cola, so in this case, for some reason it's not showing here. That may happen sometimes. So if you want to confirm if this happens, and this may happen sometimes because this broker or online services or Robinhood or Yahoo Finance or whatever, they're pulling this information from a API, like an automated software solution that pulls the information from a database. And so those databases are not perfect. So if you see something that's incomplete or something that looks strange, like a really high number or really no number or negative numbers or whatever, and since you're thinking of investing here, you want to put your money into something you understand. You want to confirm these numbers, and that's the way to confirm these numbers is to actually go to the financial statements and do the calculations yourselves. That's why it's very important to understand how these things are calculated, not just looking at these ratios as they're defined by an API, because you don't want to make an investment decision on inaccurate or incorrect information, obviously, because that could lead to obviously very bad consequences. So please keep that in mind. Now the last couple of metrics we're going to look at are related to debt or liabilities of a company, and that relates to its financial strength. So the first one is important, and it's called current ratio. And current refers to short-term assets and short-term liabilities. And the textbook definition of short-term in this case is anything that is usable or any debts that are maturing in less than 1 year, within 1 year. It could be a day, it could be 11 months, it could be 6 months, whatever the case may be. So current, so there's two types of things. There's current assets and there's current liabilities. Liability is synonymous to debt. And what current assets would include is cash or accounts receivable, inventory, anything that I can reasonably expect to become cash for the company within 1 year and during any time less than 1 year. And then the current liabilities would be anything that the company is obligated to pay within 1 year. So any payroll, electric bills, bonds that are maturing in less than 1 year that they need to pay, bank borrowings, lawsuit, litigation, anything that the company is expected to be obligated to pay out in less than 1 year. And so to get the current ratio, you simply put on the top, you put the current assets, and on the bottom you put the current liabilities, and in this case for Coca-Cola, it comes to about 1.13. and a higher number is generally better. And what this means is Coca-Cola's current assets, the cash and the things that can be converted into cash in less than 1 year, is about 1.13 times more than their current liabilities. So this is not a very high current ratio, and if it dips below 1, it may be cause for concern. Right now it's okay, but at least it means that their current assets, the cash that they have access to within 1 year, is greater than what they have to pay out within 1 year. So that I wouldn't worry about it at this point, meaning that they don't have to worry about not being able to pay their bills this year. And we can look, just for comparison, we look at Intel. So Intel has a higher current ratio at this time, about 1.9, and so that means even more so than Coca-Cola, Intel has an easier time paying their bills because their current assets they're almost double their current liabilities. So they don't have any problem paying their employees, paying their bills, upkeeping their machines, maintenance, paying the rent on any properties, etc., things like that. Then the other metric that we're going to look at is called long-term debt to equity, and that's here, long-term debt to equity. So what many companies do, it's very common, is they're going to borrow money. Not only do they raise money by selling stock to the stock market to shareholders, but they can borrow money. And the more debt that they've borrowed, the more they've borrowed from either banks or investors or venture capitalists, etc., to finance their operations or to expand, etc., is going to build up long-term debt, meaning debt that matures in more than 1 year. And so here we can see, just for perspective, Intel has billions of dollars of debt, 34 billion at this moment about. But that does not necessarily mean that the company has a debt problem, because you need to look at the company's debt compared to their assets, compared to their earnings, etc., and we'll talk more about that later, but just understand it at this moment. But one of the metrics that you can look at is long-term debt to equity. And what equity is after paying their liabilities off, what is the net value of the shareholder equity in the company that is remaining? And then you divide it under the long-term debt. So you would use this number as the numerator. And so then in this case for Intel, it's about 42%. And that's a fairly healthy number, especially for a company like Intel, which has a lot of revenue and a lot of profit with which to pay down debt if it needs to. And so it means that their equity is more than twice their long-term debt. So that means their equity is going to be up 100 billion or maybe a little bit more than that. So it's a healthy number compared to their debt. And then Coca-Cola has a higher value though. So their long-term debt is about almost 40 billion, but their long-term debt to equity we can see is over 200%. So when you see a high number like this, and first of all we would need to confirm that it's accurate, and we can find these numbers on the balance sheet. We would divide long-term debt by shareholder equity. And if this is a high number like this, then it does warrant investigation. Why does Coca-Cola seem to have so much debt compared to their shareholder equity? And so that's something that we could investigate. So those are some basic metrics that we've covered. We covered PE, price to earnings, price to tangible book, price to sales, price to earnings growth. We covered some metrics related to the dividend and to debt on a company, and the share price compared to the market cap and shares outstanding. So please make sure you understand these metrics before you move on to the next videos, so that you can understand the content. And these are very basic metrics that you should understand, and should understand how to calculate them before you move on to valuing a company. And one of the sites I would recommend going to, Investopedia. Investopedia, if you want to do some research on your own, is a very good resource. They have, as it implies, it's a investment encyclopedia of sorts. You can look up definitions for things. So for example, if I wanted to just educate myself more on something basic or advanced, I can look at current ratio. It'll describe what is current ratio, how do I calculate current ratio, and it'll help you, define these current assets, current liabilities, what are the factors that go into it, and related things. You can, you might fall into an Investopedia black hole. So I definitely recommend Investopedia if you're serious about studying and gathering more knowledge about investing. But other than that, please like and subscribe, and I will continue to release videos like this as well as analysis of companies and interesting investment opportunities. So I hope to see you guys in the next video. Take care.